Look, in the next 18 months, almost 1 million homeowners are going to get a letter that could force them to sell. And here's the crazy part. Most of them have no idea it's coming. If you own property, you're trying to buy, or you've been renting, wondering if you'll ever afford your own place, what I'm about to share will completely change how you see the UK housing market. This isn't just a slowdown. We're watching a complete restructuring of who gets to own property in this country. And by the end of this video, you'll know exactly which side of this divide you're on and what to do about it. So here's what nobody wants to admit. The UK property market has literally broken in half. Up north in Newcastle, Leeds and Manchester, houses are selling faster than they have in years. We're talking properties going under offer in less than a week, sometimes with multiple bidders fighting over the same place. The northeast has seen prices jump nearly 8% in just 12 months. Meanwhile, down south in London and the southeast, it's like someone hit pause. Asking prices are creeping down month after month. Sellers are watching their properties gather dust on Rightmove, and the ones getting offers are accepting way less than they expected. Think about this. A 3-bedroom house in Newcastle costs around £180,000. That same house in outer London, £450,000 or more. The gap between regions has become so extreme that people are genuinely questioning if staying in the south is even worth it anymore. But here's the real question. Why is the north booming while the south is stalling? The answer is pure mathematics, forcing people's hands. The average London salary is higher, sure, but it's nowhere near high enough to justify mortgage payments that are double or triple what you'd pay up north. When you factor in commuting costs, council tax, and day-to-day expenses, someone in Manchester with a £200,000 mortgage is genuinely living better than someone in London struggling with a £400,000 mortgage and an hour-long commute each way. The data is wild. Supply in London has shot up nearly 19% compared to last year. More sellers are flooding the market trying to get out. But actual transactions? Down 28% year on year. You've got all these people listing properties, but nobody's buying at the prices sellers want. That creates a standoff. And in a standoff, there's only one direction prices can go. Now here's where things get serious. Between now and the end of 2027, roughly 800,000 homeowners are going to watch their fixed-rate mortgage deals expire. These are people who locked in rates at 2%, maybe 3%, back when borrowing was basically free. Now they're coming off those deals and staring at rates of 5% or higher. Let me make this real with actual numbers. If you borrowed £250,000 at 2%, your monthly payment is around £1,120. Not too bad. But when that deal expires and you remortgage at 5%, that same mortgage suddenly costs £1,460 a month. That's an extra £340 every single month, over £4,000 a year. And if you fall onto your lender's standard variable rate, you could be looking at 7% or even 8%. At 7%, that £250,000 mortgage now costs £1,750 a month. You're suddenly paying an extra £630 compared to your old deal, over £7,500 a year just in additional interest. For tens of thousands of homeowners, especially those who bought at the peak in 2021 or 2022, this isn't sustainable. They're facing an impossible choice. Find an extra few £100 every month somehow, or sell up. So what happens when nearly 1 million people hit this wall at the same time? Here's what makes this brutal. There's a massive generational divide happening. If you're over 65, there's a 61% chance you own your home outright with no mortgage. You're watching your property value tick up slowly, with no monthly payments to stress about. But if you're under 45, you're almost certainly carrying a mortgage, and you're feeling every single rate rise like a punch to the gut. Younger homeowners hold the bulk of the UK's mortgage debt, which means they're getting squeezed the hardest. This isn't about blaming anyone, it's just reality. But what it means is that the pain of higher interest rates is concentrated almost entirely on one group, and that group is now flooding the market with listings because they physically can't afford to stay. Now let's talk landlords, because this is fascinating. Last year, 19% of landlords sold properties. Compare that to just 8% who bought new ones. That's a massive net loss of rental stock. Recent surveys show 41% of landlords are either planning to reduce their portfolios or exit entirely within the next few years. Nearly half of all landlords are considering getting out. Why? Mortgage rates have more than doubled for them too, but they can't just pass all that cost on to tenants because there are real limits to what renters can afford. Then there's the Renters Reform Bill, which scraps Section 21. Landlords can no longer evict tenants without a specific legal reason. From a landlord's perspective, this adds serious risk. If you get a problematic tenant who stops paying or trashes the place, it's now much harder and more expensive to remove them. Then there's the furnished holiday let changes coming in April 2025. All the tax benefits are being stripped away. Landlords are looking at their spreadsheets and realizing the numbers don't add up anymore. But wait, if landlords are selling, where does that leave renters and buyers? This landlord exodus is creating a perfect storm with two opposite effects happening simultaneously. On one hand, rental supply is shrinking, pushing rents up. Tenants are competing harder for fewer properties. On the other hand, all those former rental properties hitting the sales market are adding to supply, which is pushing house prices down in some regions. It's this bizarre situation where renters are paying more while house prices are falling. Former rental properties now make up a huge chunk of listings. In some areas, literally 1 in every 5 or 6 properties for sale. And they're being snapped up by first-time buyers and families who were previously stuck renting. In a weird way, the landlord sell-off is creating opportunities for people locked out of home ownership for years. But here's the fascinating part. While the overall market struggles, there are pockets that are thriving. Manchester, Bristol, and Glasgow are seeing serious growth. Buy-to-let mortgage applications surged 32% in early 2025. These aren't accidental landlords. They're professional investors who understand the numbers, who've planned for rate rises, and who see the current chaos as opportunity. The North and the Midlands are where smart money is flowing. You can still buy a decent 2-bedroom flat in Liverpool for under £120,000 that'll rent for £800 a month. That's an 8% yield before costs. Even after maintenance and void periods, you're looking at solid returns. Compare that to London, where you might pay £400,000 for a flat that rents for £1,800 a month, barely 5% gross yield. After costs, you're lucky to see 3% net. The numbers in the south just don't work for new investors anymore. First-time buyers are also seeing real opportunities. With landlords selling and transaction volumes down 28%, there are fewer buyers competing for each property. If you've saved a decent deposit and can secure a mortgage, you actually have negotiating power. Properties confidently listed at £300,000 6 months ago are now being quietly reduced to £285,000 or £280,000. That's real money saved just by being patient. So with all this chaos, what's actually going to happen next? Most analysts predict modest growth in 2025, maybe 1% nationally. But here's where it gets interesting. Savills forecasts total growth of 24% over the next 5 years, through 2029. That's nearly a quarter more in value, though not evenly distributed. The theory is straightforward. Wage growth averaging 2 to 3% annually, the Bank of England gradually reducing rates to around 4%, and confidence slowly returning. Once transactions increase, prices naturally follow. The opportunity window is right now. During this period of uncertainty when everyone's frozen, that's precisely when you can negotiate the best deals. Here's what you need to do based on your situation. If you're a homeowner coming off a fixed rate in the next year or two, talk to a mortgage broker today. Understand what rates you'll qualify for. If the numbers don't work, it might be better to sell now while you have equity. If you're renting and thinking about buying, do the actual math for your specific situation. Don't buy just because you feel you should. If you're in Manchester and can buy for £180,000 with payments equal to rent, buying makes sense. But if you're in London facing a £400,000 mortgage for a tiny flat and only staying 3 years, renting might be smarter. If you're a landlord, make an honest decision about whether you're in this professionally for the long term or hanging on out of stubbornness. If you can't make the numbers work at 5% rates with increased regulation, selling might be right. But if you have quality properties in strong locations with solid cash flow, riding this out could position you well. If you're an investor with capital, focus on areas with strong fundamentals, good transport, solid employment, universities, hospitals. Run conservative numbers assuming rates stay at 5% and build in void periods and maintenance costs. The UK property market of 2029 will look very different from 2019. The cheap money era is over. The new market rewards people who do their homework, understand the numbers, and can spot genuine value where others only see risk. Pay very close attention to what's happening. The market is telling you something important right now, and if you can read those signals correctly, you can make decisions that put you in a much better position for whatever comes next. If this helped you see the market more clearly, subscribe so you don't miss what's really happening in UK property.